Hey everyone, and welcome back to the channel where we demystify the markets and uncover unique opportunities. Today, we're diving deep into a stock that's recently landed on our hard-to-borrow screener, Smart Logistics Global Limited, trading under the ticker SLGB. This isn't just a generic look at short interest. We're going to break down SLGB's specific metrics, what makes it a hard-to-borrow candidate right now, and what that could mean for potential short squeeze dynamics. We'll discuss its incredible cost to borrow, the dwindling supply of shares, and exactly what to watch for. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Let's zoom in on SLGB itself. Smart Logistics Global Limited is an industrial sector company, specifically in integrated freight and logistics. Based in China, this company, with a market cap of around $33.08 million, provides business-to-business contract logistics solutions. Think industrial raw materials, line haul and only transportation services, plus value-added services like truck parking, freight storage, and truck examination. Should chart SLGB. Looking at recent price action, SLGB has seen some significant volatility. Today, the stock is down 23.47%. However, zoom out a bit, and over the last 5 days, SLGB is actually up a robust 36.86%, and over the past 30 days, it's gained 2.88%. In terms of volume, today's trading saw 3,300,544 shares change hands. That's actually quite a bit lower than its 30-day average volume of 9,645,038 shares, putting today's relative volume at just 0.3 times the average. What is cost to borrow and why it matters? Before we get into SLGB specific numbers, let's quickly explain what cost to borrow for CTB is. When you short a stock, you're essentially borrowing shares and selling them, hoping to buy them back later at a lower price. But borrowing shares isn't free. Brokers charge a fee for the service, and that fee is called the cost to borrow. It's usually expressed as an annualized percentage. Why does this matter? Because a high CTB directly impacts the profitability for short sellers. If the fee is too high, it eats into their potential gains, or even pushes them into loss just by holding the short position. And yes, these fees can absolutely exceed 100% annually when a stock is incredibly difficult to borrow due to high demand and low supply. Why this stock is hard to borrow right now. This is where SLGB gets fascinating. Our hard to borrow screener flight Smart Logistics Global Limited for some truly eye-popping numbers. The current annualized cost to borrow for SLGB is an astonishing 675.6%. That's not a typo. And it's not just high, it's rapidly escalating. Over the last 5 trading days, the CTB has surged by 360 percentage points. Highlight CTB. Why is it so high? Because there is virtually no supply. There are only an estimated 8,000 shares currently available to borrow against an estimated float of 3.0 million shares. This extreme scarcity, combined with the soaring fee, signals that short sellers are paying a premium for every day they hold their positions. On our internal 0-100 scale, which combines CTB, momentum, borrower supply, float size, and technicals, SLGB currently registers a composite squeeze score of 58.5. Now, it's crucial to understand, a super high cost to borrow does not guarantee a short squeeze. Sometimes, it can simply mean that short sellers have incredibly strong conviction that the stock will eventually decline, and they are willing to pay almost any price to maintain their short position. But it certainly adds a lot of pressure. Squeeze mechanics explained. So, how does a short squeeze happen? Imagine short sellers betting against SLGB. As the cost to borrow climbs, and the available shares shrink to just 8,000, holding their short becomes increasingly expensive and risky. If the stock price starts to move up, even a little, the short sellers face mounting losses from both the rising price and the daily CTB fees. At a certain point, some short sellers are forced to cover their positions. To cover, they must buy back the shares they initially sold. This buying pressure, even if from forced covering, pushes the stock price higher. That higher price then puts even more pressure on other short sellers, who also start to cover, creating a positive feedback loop of buying that can send the stock soaring as a short squeeze. Dilution risk check. An important step in evaluating any potential short squeeze candidate is to check for dilution risk. Dilution happens when a company issues new shares, increasing the total number of outstanding shares. This can seriously undermine a short squeeze thesis because new shares come into market provide an additional supply that short sellers can use to cover, or it can absorb buying pressure and prevent the price from rising. For SLGB, we've performed our diligence. We found no recent dilutive SEC filings such as -1s, -3s, or 424 BS in the last 90 days. Additionally, there have been no recent reverse splits reported for SLGB in our look-back window. So, for now, the dilution risk appears to be low, which is a positive sign for any potential squeeze scenario. Just a quick reminder. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. For SLGB, what should you keep an eye on? First, continue to monitor that cost to borrow. Any further increases will amplify the pressure on shorts. Second, watch the number of shares available to borrow. With only 8,000 shares currently, any further reduction would be a massive indicator of extreme scarcity. Third, look for changes in price action, particularly on high volume. While today saw a significant drop on lower relative volume, a reversal with strong buying volume could be the catalyst. Fourth, keep an eye on overall market sentiment and news surrounding Smart Logistics Global Limited. Remember, these situations are highly volatile, as SLGB's recent 36.86% jump over 5 days, followed by today's 23.47% drop, clearly illustrates. SLGB Smart Logistics Global Limited presents a classic hard to borrow setup with its astounding 675.6% cost to borrow and near zero borrowable shares. While this puts immense pressure on short sellers and has earned it a 58.5 composite squeeze score, it is critical to remember the market's unpredictable nature. High CTB is a warning to shorts, but not a guarantee of a squeeze. We're providing this information purely for educational purposes to help you understand the mechanics of these high-octane situations. If you found this deep dive into SLGB helpful, please give this video a like, subscribe for more unique stock breakdowns, and let us know in the comments what other hard to borrow stocks you'd like us to analyze. Thanks for watching, and we'll see you in the next one.